The job situation in the U.S. is starting to pick up steam, but to the downside. Does this mean double cuts are coming from the Fed in September? And Trump wants crypto in your 401k. Hello, new asset bubble. Let's talk about it. All that and more in today's Blueprint. After hours. Welcome to After Hours, Tariffs Post for Friday, August 8th, 2025. I'm one of your hosts, Tom Hartman, joined tonight by Peter, Exit Liquidity Hartman, to break down the madness. After Hours is Blueprint is your go-to live stream for sharp, trader-focused market commentary presented by Traders Post, the ultimate advanced trade execution platform on the planet. But more on that later. For now, I want to turn to Peter and ask, have you heard about the jobs numbers and what it's pretending for the future? Do you feel the danger, the precipice that we're on for what can happen for the unemployment rate?
I didn't realize we're on a precipice. Last I heard, 250,000 jobs downward revision. BLS admin fired, which are you not allowed to fire government officials? Like I don't understand the drama there. They got the numbers wrong. They always get the numbers wrong. Then they should have always been fired. But I didn't realize that it put us on a precipice.
Well, the unemployment rate has been low for quite a while now, right? I think it's been hovering like a 4.1. It just ticked up to 4.2. But do you know what always precedes the unemployment rate going up?
Rate cuts.
It going down.
Oh,
it going down. So the unemployment rate has been down and has not fallen. It's been stable and now it ticked up. So now we're looking for unemployment rate issues here. Now the issue, what we've been seeing is stuff like the ISM, which has been troubling me. The ISM came in at, what is it, 46.2, 46.4. It's a diffusion index. It's a diffusion index that tracks the non-manufacturer sentiment. It's a sentiment survey for different market participants within the supply chain.
I'm sorry.
When most people who, not like you, people who make real decisions for manufacturing and wholesalers and mining and production, when more than 50% of them think that things are going to be better in the future, that number goes up. When they think it's going to go bad in the future, that number goes down.
Why didn't you just say that?
And if that number stays below 50 for a while, that's like not usually a good thing. In fact, it usually ebbs and flows and ebbs and flows. We've shown it on the stream before. Let me just go ahead and show that to you right now to remind you. But essentially, we're at 46.4, which is unpleasant. Oh, let me just share my screen 1 second. All right, so we have the PMI.
Switch?
Yeah, go ahead.
Click on hide at the bottom there.
Sure, 1 second. Where are you? Should be you. All right, so we're at 48 here. And so we have not been rising. Right, so we are expecting growth, or at least this is a diffusion index and it's a survey, so it's expectation of growth. And what we're seeing is that people are not seeing that. And in fact, I haven't seen this level of sideways action in a while. I mean, I say but we haven't seen this. It's usually been up, down, up, down, up, down, up, down, and we're not getting that. And so this is a period of like stagflation that's happening right now. But then you add to that stuff like the for the jobs numbers, you have the 10-year note, the 10-year U.S. Treasury was down to 4.255%. It was at 4.3 before, and the 30-year came down. All these bonds, their interest rates are coming lower. If you take a look here at the bond rates, you can see here that they've actually been falling. So this is indicating disinflation or maybe even deflation, which we talked about last Friday. But the initial jobs numbers, that came in higher than expected at 226,000 versus 221 expected, up from 219. We have continuing jobless claims that's up at 1.974 billion, million, up from what it was before. So we have a weakening of the labor market. And once you start seeing the weakening of the labor market, it means it's going to continue happening for a while. Because once it shows up, it means you're seeing the tip of the iceberg of this process that's happening underneath. There's a bunch of people who will be laid off, a bunch of people who are currently laid off, or in the the last 2 weeks, the last 3 months, people who are in their severance period. All these things happen before you get to the unemployment rate going up, and so that's concerning.
Does AI factor into this at all?
Yeah, so you get people getting laid off in the tech sector, so those white-collar jobs that are also being lost without any real expectation that they're going to come back. And so you're expecting, recession then, right? At the same time, what you're seeing is, all-time highs for major assets and indices. So you normally see that at the top of the bubble. You normally see that at the top of the global financial crisis, at the top of the dot-com bubble. It's sort of like, look out below. We might be on a cliff because the momentum of asset prices going up and things going bad for the economy. Well, there's a mean reversion that happens there, and then you can have a big drop. So it's nerve-wracking. Now, I want to actually pull up. The reason I care about that is so that we could trade off of it. Right, so there's all kinds of trades there that are great for that. You could be shorting bonds, not financial advice. Do your own research. You could be shorting bonds if you think inflation is good. It's deflation right now, and that rates will head lower. Heck, they might even go down to zero. So you want to be shorting bonds. You probably want to be long gold, because when there is issues with the global financial system, gold is the safe haven assets of central banks, and so you can be a little barnacle on that tortoise and just ride that wave up with gold. So there's different types of trades you can take. But here, as you know, I've been a big advocate of the Polymarket trade. Events-based trade.
Okay, we went a full 8 minutes without you mentioning Polymarket. That's a wrap.
Well, before we get there, all right, well, let me just give a little teaser here of what that bet can be. So if we take a look at Polymarket right now, and you can have equal types of bets on Kalshi for the US people. Right now, the betting market is pricing in a 76% probability that the Fed cuts by 25 basis points in September, on September 17th. 76%, right? If you believe that's true, you can go ahead and buy that. $100 gets you an extra 30. Make it $30 on that. All right? But what if they cut by 50 basis points? Well, then you get yourself a cool $1,500 on a $100 bet, which is pretty good. That's pretty good. 150 to 1 here. I'll take that bet. And so the question here is, what is the likelihood that this can happen? Well, two things we know. The Fed likes to keep things like consistent. They don't like to change things up all the time. So we did 50 basis points cuts for COVID and lockdowns, and we did the 50 basis points rise from when they were hiking interest rates. So chances are they're going to stay at 50 basis points. I'm surprised more people aren't saying this. They're generally going to stay at 50 basis points. That's my assumption. They don't like changing things up. All of a sudden now we're going to cut by 25 basis points. Maybe not.
Is this the teaser?
Yes. So let's go ahead and give me 1 second to pull this up. And let's hear what Jeff Snyder from Eurodollar University, my go-to plumber for the Eurodollar system, the global financial system. Let's see what he has to say. We're going to take a look at just the first part of this. You guys can always go to his channel at Eurodollar University and watch the full video. Definitely worthwhile.
Yeah, the Federal Reserve is going to cut by 50 basis points at its next meeting in September. As I told you about at the end of last week with Steve, in the wake of the shocking jobs report for the Fed, watch this week. You're going to see Fed policymakers come out and start talking about...
I hear an echo, I think, through your... Ready?
So should I play it, or you can put auto noise cancellation on?
It is already on. It just must be too loud. When you don't talk, yeah.
Okay.
About how
just turn your microphone off.
And that's just what we're getting. I mean, there was already 2 dissenters at its last meeting last month anyway.
Can you restart it? Sorry.
In treasuries and as well as money market. Yeah, the Federal Reserve is going to cut by 50 basis points at its next meeting in September. As I told you about at the end of last week with Steve, in the wake of the shocking jobs report for the Fed, watch this week. You're going to see Fed policymakers come out and start talking about how dovish they were. And that's just what we're getting. I mean, there was already 2 dissenters at its last meeting last month anyway. Plus, in treasuries and as well as money market options, money is pouring in on not only just rate cut expectations for September, it is really pouring in on a 50. There were already a number of softer indications that not everyone at the FOMC was happy to just sit there and wait and wait and wait for tariff inflation that was based on really bad theory, putting up zero evidence. In fact, as I keep pointing out, price measures like the CPI and especially the PPI haven't just been devoid of inflation evidence. They've actually gone over to the weak side of the economy quite emphatically.
All right, so those are 2 things that matter quite a bit here. That we've had dissenters within the voting members and non-voting members of the Fed that are dovish, which means they want to cut. Right now, the whole thing with the with these voting members is that it is it's a show, right? They're doing that for us. It's forward guidance. They're not really fine. They might be arguing amongst themselves, but if there's really a disagreement that they don't want us to know about, they won't let us know about it. So if we do know about it, that's them signaling to us that, hey, in the future, when we make this change, it won't just come out of nowhere. See, we've been saying this the whole time, right? So the centers are there. And so then you also have, because they're seeing the same data we all are. Right? They're seeing that the reason why they've been keeping the interest rates high is because they were worried about tariff inflation, right? They were worried about tariff inflation, that the Trump tariffs would cause prices to go up, and that would flow through the consumer in the same way that the supply chain shock of 2021, 2022 caused inflation to peak. So they didn't want to be on the other side of that. They certainly didn't want to be cutting while that happened. There's no tariff inflation. There seems to be no tariff inflation whatsoever, and no one can really point to it. And consumers are not complaining about it. It's not flowing through. We're not getting that in anecdotal evidence, and we're not even getting the Fed or anyone saying, "Well, yes, this is what we're seeing." In fact, the inflation rate appears to be negative. We talked about this last Friday.
0.3
by 0.3%. And so the Fed should be cutting. All right. So the second part to that, I was making the case that the Fed would cut 50 basis points because they have been doing that. They've been cutting and raising it by 50 basis points. So that would be the new normal. It's sort of like quantitative easing. They're not like, okay, we're going to do a few $1 million of quantitative easing. No, they're going to do billions of dollars because they've been doing billions of dollars. And you can't put the genie back in the bottle. It's always more later or exactly what it was before. Okay. If they are behind the curve, and they're late again, then they would again leap forward with 50 basis points and go, hey, we got to cut drastically because we're seeing signs and we want to get ahead. So I can't really see a scenario in which they cut 25 basis points unless they're like forced to do it and it's just for show sort of thing. That to me seems like what would be the case. Now, when we take a look at the Fed Watch tool to see what is the expectation of the market of what will happen, we're seeing that for September 17th, the September 17th meeting, there's a 89% probability that the Fed cuts by 25 basis points. All right. So the futures market, which is like the bet-in market, but for people with real money, the futures market is pricing in one rate cut, 25 basis points. So we're not even in the pause territory, which is 10% chance. We're not even in that pause territory. There's a consensus. There's a consensus that we're going to be cutting. So then it's just a short leap and a hop to think that we might cut by 50 basis points, right? So far, does that seem credible at all, Peter? That hey, we could indeed, if the market is already pricing in a cut, it's less of a hop to think that they'll cut by 50 basis points.
Well, yeah, but I mean, yes, if the Fed isn't political, like I'm not 100% convinced this isn't on purpose to hurt Trump. Now, look, this is conspiracy alley over here, conspiracy corner over here. I don't know, like I don't know anything about this, but I don't understand. You told me, hey, Peter, they're always late.
Yes.
When they come back after being late, do they always do the right thing?
Yes.
And the right thing here would be to cut by 50 basis points. So if they were to cut by 25, you would call that what?
That would be for show.
Political.
Yes. First, just to answer your thing, I don't see any reason why the Fed would want to hurt the president. Why would the boss of the president care about hurting their underling? It doesn't make any sense. It's Federal Reserve, administrative branch, executive branch, House, judiciary, House. This is how this goes. So I don't see why they need to hurt him.
It goes how again?
No, I'm joking. It's supposed to be, they're supposed to be all equal, and the Fed actually works. But I'm saying the central banks are top, then the president, then the rest of us. And so I see no reason why they're not like equals fighting out. The Fed just has to wait around until the president changes. Like it doesn't make any. I don't see why that matters to them. Plus, what do they gain by that? Jerome Powell hurts the president. What? Like he cares? I can imagine he cares who the president is.
Well, it's to hurt who comes next. A bad economy leads to people wanting to change leadership, change from the Republican Party to the Democrat. I mean, I don't know.
What do they care?
I don't know.
I don't see any reason why they would care. All of the Fed chairmen, I've seen all the board members seem to be like nonpartisan in that sense. I see nothing that indicates that they would ever go so far as to hurt the economy just to make that point. So I don't see that happening. And so what I think they want is just to appear independent. That's the political part. They want to appear independent, so they don't want to do the thing that the president's been calling for them to do. That's it. But at some point, they'll have to.
Chet is asking, what outcomes are y'all discussing?
Right. So the idea here is that the futures market is already pricing in a 25 basis point cut, 75% chance over here, and 80 something on Fed Watch tool. So if you just thought you just wanted to bet with the Fed Watch tool, which is generally accurate, right? Whatever is more than 80%, more than 85% on the Fed Watch tool is generally what's going to happen. Just betting for that, you'll make 30%, 33%. Right?
How do you make that trade on the market if you don't want to do Poly or Kalshi?
Sure, you could absolutely make it on the market. You could be shorting bonds. You could be doing a bunch of things. The thing is that if you do it in the futures market, that's already priced in at 86%. So you're not making any premium on that. But if you use a bet-in market, then you would make a premium on it.
Not financial advice. Do your own research.
Absolutely. Now, the question here is 7% chance of a 50 basis point cut reasonable? Or should this be 20% chance, 50% chance? If that's the case, even before we get to September 17th, as the rhetoric builds up and people think, hey, maybe there's a higher percentage chance that we do get a 50 basis point cut, then this will go up and you can make money on this even before the trade happens. All right. Now, aside from Polymarket, which I always love. I love placing the bets on the Polymarket. It's a great idea if like you want to, or any event-based site. It could be the event-based stuff on Interactive Brokers. It could be Kalshi. I just use Polymarket as a blanket term for these event-based markets because it allows you to not have to worry about trading options on currency futures in order to get the trade in. It's a little bit easier to understand. But gold has been going up dramatically, right?
Just before you jump into gold, the chat here. First of all, hi, Aventura. Hello to Emmanuel. Thank you to everybody who's watching. Like and subscribe if you like this type of content. We had a question in the chat. Okay. Emmanuel asked, I'm wondering if y'all are twins. Yes, we are. I don't know if we're fraternal or identical. That's usually the next question. Don't know. But more importantly, what tickers are y'all watching? So, Tom, you're just talking about gold. I wonder if if you have any tickers in mind for what we're discussing here and what we're about to discuss.
So personally, I'm not an individual tickers guy other than Bitcoin. I prefer asset classes. I prefer indices because then you get, you don't have to worry about idiosyncratic risk, right? So the people who bought before AMD over NVIDIA for the play on chips for AI, one won, one lost, right? Compared to the other one. But if you buy the index for that, if you buy a basket, then you gain the benefit of both moving up. And so I much prefer expressing my bets in ES, in NASDAQ, in gold futures, oil, Bitcoin, and US dollar, or shorting or long the euro dollar pair. That's what I normally prefer to do. Because over here, so for gold, and there's usually two ways I'll go about it. I'll either trade the gold futures, or I'll trade options on gold futures. I do prefer options on gold futures because for the same type of move, you can get 10 to 100 times more payout if you're right, but then you also have to be right in the timing, right? As opposed to holding the futures contract because you don't know how long it'll be. So that's normally how I would express my bet. But for individual tickers, I find that a little bit harder, a little bit more unpleasant to deal with.
How do most people feel about it? Like, do most people trade tickers, or is it like what you talked about, index?
Oh, there's all kinds. If you're, it depends if you're a short-term, medium-term, long-term trader. It depends how much capital you have, how much time you have. I'm like trading it, right? So I'll purchase something, and I'm expecting maybe to hold that for a 2-week move, a 1-week move, where someone else might just be like, well, what do I buy for the next 4 years? Like, I don't want to have to think about it. So it'd be hard for me to say, go ahead and buy gold for the next 4 years, but it's easier for me to say buy gold for the next 6 months. So it really depends on what your risk tolerance is, how much capital you have, and how long you want to hold the position. All right.
Gold.
So yes, for gold. So I just want to mention here that generally speaking, when the Fed cuts rates, historically, when the Fed cuts rates, markets drop initially because that is usually they're responding to something bad. Usually some event occurs, some financial event or some company collapses or whatever it is that causes this drop, or geopolitical risk causes the drop. And so they come in on the white horse to shine a light on a white horse in order to cut rates. So that would be an opportunity in order to buy into anything that you think will go up during recessionary period, rate cutting cycle, or what have you. So gold does this. Gold will dip, not always, but usually will dip pretty suddenly along with equities as the dollar goes up in the crisis moment. And that's where I like getting in for whatever trade I'm going to be doing. That's where I would be buying gold for the upside. The other thing I want to pay attention to here is the dollar. So the dollar has been worrying me, concerning me. Where the dollar is right now is so on a knife's edge, most people have no idea. All right. So we have the dollar here that is was been in a downtrend since the beginning of the year. Okay, and we're now bouncing. Not only did we bounce below or drop below the 100 level that's been around for several years for the dollar, we went to a lower bound that's been there for even a lower trend that's been there for even longer, or just as long actually. So this is a low that this trend was developed since 2014 down here. So you can see that we skyrocketed up from there, skyrocketed up the last time we were on there, and now we're on again. So the idea that we might skyrocket up to 120 or whatever on the Dixie, not unlikely. And if that happens, guys, we have topped everywhere. It's all topped. And good luck over the next, let's call it, 4 years.
No.
If, however, this is a sign, what we do is we reverse, which looks like it might be what's going on over here, where we reverse and head down lower. That means the dollar would head down towards the 91, 92 level, which would be great for equities, great for Bitcoin, great for gold.
What do you think is going to happen?
I never try to guess what I think is going to happen.
Why don't you try to guess what's going to happen?
Well, if I were to guess, and this leads to the second story that I wanted to touch on, Donald Trump, I'll answer this and we'll circle back. Donald Trump has put in a executive order, I believe it is, in order to allow people to have private equity and crypto within their 401k. Okay? Now, on the surface, it sounds crazy. Private equity is not publicly traded. How do you mark that to market? What is the what's the process? How are people to vet any of these companies? Like, you're going to invest public money into a private equity? Like, normally you can't get into private equity. You don't have enough money or the connections or anything like that to get in. But all of a sudden, they're going to sell these structured products for private equity for you to invest in inside of your 401k. The whole thing seems crazy. It's just as crazy as someone said, "Hey, we're going to allow 401ks to invest into comic books." All right, because you don't know what's going on with the private equity stuff. They could make these things the valuation they could adjust the valuation of the asset just because they're trying to sell it to the 401ks for a higher price. And who's sitting around going, "I know what my 401k is buying"? Most people don't even know what they own. So that is crazy. We have a question here from Emmanuel. Can you read that, Peter?
Side question: when dollar drops unbelievably low, it has sometimes been a sign for cataclysmic event that rebounds it.
Exactly. And so it could be pretty dramatic. Bounce on a dramatic bounce on the dollar would coincide with massive liquidity issues for the entire world. Well, entire world who trades dollars, which is most of the global financial system. So that would be pretty significant.
Aventura
it doesn't mean you can't have a bull market or anything like that, but it does make it less likely that you'll have that.
Aventura Trader says pro crypto is the way to go. I think he's liking the whole putting it in your 401k. It sounded like you were kind of on board with that. What was
okay? So yeah, that's the other part. All right, so that's the other part. So the private equity part, I don't really care so much. I know that Robinhood was getting on the game for that. They wanted to allow for the tokenization of private equity stuff like OpenAI, and I forget what the other one is, to trade in European markets, eventually to open up the rest of the world or the rest of the market. I don't like that so much. I am not sitting there going, "Hey, I want a tokenized version of OpenAI." It doesn't give me any dividends. Do I get any voting rights? This is just a way of me being exit liquidity for that company. I have no idea. Crypto, however, I do know is a Ponzi scheme. I mean, I do know is a new digital asset for the ages. All right. And the Trump administration has been very pro crypto. And if the regulation allows for people to put money in their 401ks, I don't know if you guys know what this means, right? So that means people could automatically be purchasing crypto every week when they get paid. Right? Just to be clear, the 401ks oftentimes are tied to people's jobs, and they get to invest money that comes off their check every week, every 2 weeks, whatever they get paid, in order to buy the stock market. They're not sitting there picking out what to buy and what assets to buy or whatever. It just happens automatically. And then oftentimes it's an employer matching, right? So that means there's a flow of money that goes into the market called passive investing that purchases assets within the market indiscriminately. When $1 comes in order to purchase an asset, they buy $1 worth of the asset right then at whatever price it is. Michael Green has claimed the field on this idea of passive investing and the effects that it has on asset prices that go up. Because if you have this steady flow that comes in and it doesn't care what the price of the asset is, well, what happens to the price of the asset? It keeps going up. And if any active investors ever sell that asset going, hey, it went up a lot, I should sell because there's going to be a pullback, and then there isn't any pullback,
right?
They are either going to miss out or they have to chase at a higher price in order to buy it, which causes the price to go up higher and higher and higher. Think GameStop, but your entire life in the stock market. So there's a reason for that, why when we take a look at the stock market, we see this.
So how likely is this to happen?
Very likely. It's happening now. This doesn't come from nowhere. All right, guys? Let's just make that clear. This move up has happened. Peter, if I were to ask you, around when, if you had to guess, around when did the amount of passive investing become significant? When would you say that is?
2009.
So it's a little bit past that. It's basically around here, around 2012, 2013. Passive investing became far more prevalent. Now, it didn't exceed active. I think it only started exceeding active around here. If I'm not mistaken, I don't know the exact date. But you're seeing the effect of it, that it just causes prices to go up and up and up and up and up and up and up. Now, President Trump wants to give this gift to us. Encourage all Americans to sight unseen purchase crypto, the top crypto assets. What do you think then happens to those crypto assets if people start purchasing them sight unseen? To the moon!
To the moon!
All right? Now, am I saying run out and go right now? It's going to go to the moon next year? No. Personally, I think that the regulations, it's under Trump right now. We don't know if the next president comes in and decides, let's roll back all the things Trump did. Let's be anti-crypto. Let's undo all that because that has the stink of the orange man on it. I have no idea. So I would wait to see what the next administration does. So I guess hopefully vote Democrat and get them in order to see what the regulations are going to be.
Vote for whoever you want.
And then if it is they keep the regulations on, then you have the expectation that now institutions will start making products to sell this to those who choose 401k plans, right? Because it's either the employer or people get a catalog, they choose what they want to invest in, and this happens. And so then you can see crypto really get launched. But that's more of a not this cycle, next cycle sort of thing, right? So that's why I'm very excited about the potential 50 basis point cut and volatility events that might cause a dramatic downturn in the markets. Because once we clear out all that risk and we bottom, which we will bottom at some point, and probably sooner than you think, then we could think about the next plan of roll right in and make money to the upside.
So you're optimistic?
If by optimistic you mean that I know winter is coming and I could survive the winter and then make money on the next spring and summer, then yes. If it's optimistic that I think the fewest number of people will suffer and there won't be a large transfer of wealth from those who have less to those who have more, no. That is pretty much definitely, in my opinion, going to continue happening.
All right. Emmanuel in the chat is asking, where do you get clear information regarding crypto? It's been very confusing for me, embarrassing to say. Following up with that, Ventura says, I think you'll like this, Tom. I follow a guy named Richard Hart. He's controversial, but always write about crypto?
Well, as far as following information about crypto, I find my life became so much easier. My trading became so much better. My investing became so much better once I stopped thinking about the narrative at all until I was already in my positions. So I wait till I'm already in my positions or I've already purchased the asset, and then I worry about what the narrative is, because then
Can
it
you
really
explain
starts
that? The narrative, what do you mean by that?
So a lot of people are convinced by a story. Some guy told me this. I heard this on CNBC. I read inside Bloomberg that this is going to be the next big thing, or this is going to be the next big flop, and they bet accordingly. Right?
But that's all manipulation.
Well, it's not necessarily manipulation. Is that there's no guarantee that the popularity of a narrative translates to the price chart. So, for example, this is a problem that I had got in one of the last times I did this mistake, which is that after Russia invaded Ukraine, there was this talk that there'd be famine. So not only did I buy 2 other freezers and stock my fridge and try to have 6 months worth of food, I also placed bets within the markets accordingly. I thought there'd be an oil shortage. I thought there'd be all kinds of different things. And so I put a bunch of money there accordingly and lost all those bets. Because turns out there wasn't an oil shortage. It wasn't the coldest winter ever. And I had food in my fridge I still have now I didn't finish eating. Because even though the narrative was very prevalent because of the fear and all the talk about it, it was really, there to sell papers and be clickbait and whatever. What? Not to say that it couldn't have happened, but if I just looked at the chart, I would see, well, the futures aren't moving dramatic. The dramatic move that I'm seeing in futures are being faded. That means those who have a vested interest, their money's on the line, their livelihood is on the line. They're not betting that this is going to happen. And the price chart tells you that. The stock chart tells you that. So I first look at the stock chart, and then I go find the narrative that supports that particular idea.
We have DJ in the chat here who's asking, who's saying, interesting time in the market. Today I purchased a few SPY December puts, somewhat speculative, but when there's talk about legit rate cuts at all-time highs, it's worth the investment, in my opinion. Do you want to pull up a chart regarding this? Do you have any analysis when it comes to the SPY?
For the SPY, well, the only thing I would mention here is that I would previously have bought December puts. All right, thinking that I want to give myself more runway in order to be hedged for that. So that's totally fine. I'm not trying to tell you that I'm like the best options trader in the world, but what can happen is that you're actually paying a larger premium in order to cover that time decay. So these puts every day now will lose money, lose money, lose money, lose money. And you could be right that the stock market will go down, but wrong by the order of magnitude and how long it takes. So I've often been in a situation where I bought December puts that expired, let's say the 3rd week of December, and the stock market drops January 5th. And I was like, I held these puts for so long, and just when I didn't have it anymore, that's when the market falls, because that's generally what happens. It's when the volatility is not well supplied, when not enough people are hedged towards the downside, that's when it falls. When volatility is well supplied, which means most of the participants, institutions, or whatever are hedged to the downside by buying puts, that's exactly the thing that makes it not fall. Because the people who sold the puts, the market makers who sold the puts, have an incentive to keep the market from paying you out. Right. And they just collect your fees.
So what do you do instead?
Sorry?
What do you prefer then, if not?
I much prefer shorter dated puts that you put on week by week, and then there's certain weeks that are more likely for a drop to happen than others. So, for example, leading up to the FOMC meeting for September 17th, it's not likely that any major things will occur, right? Or even if you thought it were, better to buy those puts around the Fed meeting, and then if it's going to drop, then you can monetize it right away. You have to get the highest gamma because they're short-dated options, as opposed to options in December that won't go up nearly as much as the short-dated ones and would cost 5 times more. And then if nothing happens around there, then you wait till the next potential catalyst, let's say in the middle of October or the beginning of November. You wait till the premium for the price of the option to come down enough that you can buy more of it without paying overpaying. So there's a discount on the options. And I just pick my periods of the year where I'm going to do that. So at most, there's only 4 periods of the year I even bother thinking about protection to the downside or looking for an opportunity to buy if I don't want to be long. And that's September, December, March, and June. This is Ken Carson talks about this. These are periods of low liquidity, volatility is not well supplied. Other than that, I don't want to. I don't like owning the puts and watching my theta decay, but it depends on different people.
Awesome. Also, on this topic, because we're talking about trading, and here at Traders Post, I actually want us to talk more about what makes you a good trader and things like that. You talked about looking at the Dixie as an indicator. 2 things. You talked about looking at Dixie as an indicator for your trades, as well as options volatility or something like that. Can you expound upon that?
Yeah, the Dixie is the easiest one for the average trader to take a look at, right? Because when you're taking a look at the dollar, you just got to keep in mind that global trade is done in dollars. Sure, other currencies are involved, but they're usually bounced off by the dollar at some point. The global debts are denominated in dollars. That's why it's a reserve currency. And so whatever the dollar is doing is giving you an idea, net, what is happening within the system. So if the dollar is going up, like we see here, the dollar has been going up since 2009. You might have heard the dollar is crashing, the dollar is crashing. The dollar is not crashing. The dollar is getting stronger and stronger year over year on average because liquidity is drying up more and more and more and more and more as we go. So eventually this will be a problem and we're gonna have to deal with it. So the Dixie is a great proxy for when it goes up, there's liquidity problems within the global system. When it goes down, there's liquidity benefits. They're adding liquidity. But just think of it in terms of what goes on. And the only way to have the dollar go up is for someone to sell an asset to buy dollars.
Right.
Makes it go up. And if more people are doing that than selling it, then the dollar goes up. That means net global liquidity is drying up because people are selling the assets in order and buying dollars. If it goes the other way, people are selling the dollars. They go, it's better for me to own this asset that's just means dollars in the future, right? That's why you're buying the asset. It means dollars in the future than to have these dollars now. Now, for the option space, it is super, super useful to understand that because what the options are basically the stock market in the future, right? People are betting in the future what they think the price will be. And so if you're trying to trade now for the future, it's sort of like seeing the goalie move to the left side of the net. I'm going to use a sports ball reference, even though I know anything about sports ball, but it's seeing the goalie move to the left side of the net. Because what he's seeing, he's looking towards you, you're running this way, you might not be seeing what's going on around you. And him moving over there indicates to you what he sees other people are doing. Right? And so you get a sense with the option space, the price for options, the premium and discount for the options, what you're paying for volatility, all that is giving you an idea of, in aggregate, what do people see in the future that I'm not seeing? And it gets all priced in. So if in the future, the call option, bet into the market will go up, is more expensive than the put option, that means people think the market will go up. In general, I'm just trying to boil this down. If the call option is higher than the put, that means people think that the market's going to go up, and so you have to pay a higher price in order to get that option.
Right.
And so that's why it's useful. And the more you learn about options, the more you can get a sense of what's going on in the future. And the options are broken down by time. So you have zero-dated options for right now. It'll tell you what they think is going to happen during this session, tomorrow, next week, the next month, next quarter, next year, 5 years out, whatever. You can have options that go out for years, and so you get the spread across the market. That once you understand it, you get an idea of what's called the volatility surface for what is the sense of what people think the price will be. And the price, you start seeing it as a ball I see it as a ball rolling down hills and going over mountains around this volatility surface. And so even if it goes up, I could be, I'm looking ahead and going, hey, but I think it'll go down afterwards because the volatility surface drops so suddenly after. And I'm not like surprised by the price when it moves. Hope that's a clear example.
I like it. I love it. I like the goalie analogy that you used there. I never really thought of it that way, this different perspective, but that is of the same field. Very cool. Awesome. Thank you to everybody in the chat. A very lively chat here today. Really wanted to engage you. Like and subscribe if you like this type of content. It really helps us out.
Before we move on to market minutes, we'll just take a quick word from our sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
All right, guys, we'll head over to the market minutes to see some of the smaller news that has been happening over the last week. But before we do, I'd just like to remind you guys, thank you very much for watching this channel. Please like and subscribe, and you'll get notified whenever we come on air, because we do a lot of shows here. In addition to After Hours that happens every Friday at 4 p.m. Eastern Standard Time, where we go over the market news, we also have a show called Price Action Live. That is me and Mike Christensen, CSO and co-founder of Traders Post, that trades live in front of you guys Tuesdays, Wednesdays, Thursdays, and Fridays from 9:15 a.m. Eastern Standard Time to around 10:30, depending on how much money we win or lose. That is a very fun show. You get to see us use Traders Post, this platform that we work for that allows you to do advanced trade execution that makes your regular trading that you're normally doing seem like peanuts, like nothing. When the idea that you can take one good trade that you're doing right now and scale it out to 20 different accounts is really a game changer. I'm loving it, and people love it all across the continent. We also have office hours that shows up on Tuesday at 3 p.m. Eastern Standard Time, where we go over just general stuff about the markets, about building out automated trading strategies and that sort of idea, but also the new features that we're developing for the Traders Post platform. Because if you think Traders Post is staying the way that it is right now, my God, it's expanded over the last couple of years, and every month, every quarter, it seems something new and mind-blowing seems to be added to the platform. And that's where we talk about it, get your feedback, answer your questions, and all that good stuff. And then finally, on Thursday, we have Blueprint, where we go over building automated strategies and setting up with Traders Post. And we do all kinds of stuff like AI development for trade execution and running your own scripts and surfacing information in new and interesting ways. It's just another one of those things that Traders Post does in order to be of value to you guys, because we want you guys to be fantastic traders.
We're actually going to be testing out GPT-5. We did a little bit of a test with GPT-5 for writing Pine script in the last Blueprint episode. You can check that out, but we're going to do a deeper dive and see what we can do with GPT-5 for next week's Blueprint. And if you haven't seen the Price Action Lives, there's some back episodes you can see. They've happened this week and last week, so you can take a look at that. If you're not into prop firm trading, you don't know what it is, you definitely want to take a look at that. It's hot stuff. It's hot stuff. And you got some great interviews on this channel, Trading About Session. You can take a look at Forex Ike, which was the last one that just went out. So all that here on Traders Post YouTube channel. Like and subscribe.
Yeah, and Ventura Trader knows this, and which is always great. We love to see him inside of the chat. It's my life goal now to get him on one of our shows. I want to see him. I want to see him talk. He trades, and it's I think it might be fun.
Our number one fan.
Yeah, love to see other people inside of the community come on, but you guys have a ways to go before you can beat a Ventura Trader. He's in our hearts. All right. A couple of things that have happened over the last week that are of note. We have the Trump revised tariff policy, which sparks market volatility. So President Trump's new reciprocal tariffs announced July 31st to August 1st, targeting dozens of countries, triggered a risk-off sentiment, causing a sharp drop in the U.S. stocks and bond yields, with the S&P 500 and NASDAQ falling significantly, which I love. As I always love to joke, especially on Price Action Live with Mike, is I never bet against the empire. And whenever the price goes down, my God, I'm going to bet on a V back up. Because every time I've not bet on the price moving back up to all-time highs, despite all the news happening in the world, I have been dead wrong. We have the corporate earnings drive mixed market signals. So strong Q2 earnings from companies like Eli Lilly and DoorDash contrasted with tech disappointments, with AMD dropping 8% and Intel slipping 2.1%. Tesla faces $243 million autopilot crash ruling. A costly lawsuit ruling against Tesla for its autopilot system led to a stock decline, with the company planning an appeal amid high social media attention. Although that Tesla stock completely reversed, and I think it's like back up again.
Kathy Woods expects it to be like trillions and trillions of dollars. Was it $20 trillion valuation? It's crazy.
Up and to the right. Up and to the right, folks. Antitrust lawsuits targets BlackRock, State Street, and Vanguard. A major lawsuit against these investment giants for alleged anti-competitive practices shook investors' confidence, impacting their stock prices and market sentiment. Did it really? Did it really? Berkshire Hathaway's mixed earnings report. So Berkshire Hathaway's Q2 earnings showed strength, but highlighted its large cash reserves, signaling caution and impacting investor perceptions of market opportunities. When Buffett is sitting on his hands and sitting on a pile of cash, maybe it's time to do the same. I disagree. Put my money in the market. Wait for it to go up. Never sell. No stop loss. That'll be my new nickname. No stop loss, Tom Hartman. AI sector resilience amid market slowdown. So despite broader market declines, AI-related stocks held up due to sustained investor interest in the AI growth theme, as noted by BlackRock's commentary. And Peter, super excited about GPT-5 and all the new AI developments. I don't see anything stopping this train anytime soon. And finally, bond market sees value in longer maturities. Edward Jones highlighted value in the 7-rate bonds as investors sought to lock in yields amid rate cut expectations. It's so interesting. It's so interesting. People, in general, if you're not in the bond market, you don't necessarily understand. But when yields fall down, right, when you'll get less for buying that bond now, it makes the previous bonds that were at higher interest rates more valuable. That's why your existing bonds go up in value when the interest rates go down, because you're sitting there with a cool 5% 10-year bond, and the other person has to buy like a schmuck at 4.25%. So they're like, hey, give me your bond. I want that 5%. And so as yields go down, bonds become more attractive. Peter?
Yes.
I love knowing about the markets. I love being part of the markets. I love being a market participant. I love when I go on the 1 second on a low float chart and I press the button and I can see that candle go and I go, that candle's me.
You've been making a lot of money recently with trading too.
Oh, whoa. No, I'm not making any money at all. I don't make anything at all. I'm dirt poor. Don't look at me for anything like that.
All right, Tom.
I have had like a 92% success rate in some of my calls. But who's counting? All right, guys, we'll be back next Friday for more After Hours. And until then, we wish you guys, everyone watching, and everyone around the world, happy trading.
Happy trading, guys.